In 1929, an economist named Irving Fisher declared, 9 days before the stock market crash, stock prices have reached what looks like a permanently high plateau. He was completely wrong. And he lost the equivalent of $140 million today. But here's what's truly disturbing. In 2007, Wall Street executives said the exact same thing about the housing market. And today, the same signs are reappearing. Stay until the end because I'll reveal why experts believe we have learned absolutely nothing from history. In 2008, when banks began to collapse, economists scrambled to find explanations. But one man had already predicted it all decades earlier. His name was Hyman Minsky, and in 1974 he wrote something that would be ignored for 34 years. A fundamental characteristic of our economy is that the financial system swings between robustness and fragility, and these swings are an integral part of the process that generates the economic cycles. Minsky was not talking about coincidences. He was describing a mathematical pattern that repeats in economic history every 15 to 20 years. Minsky identified 3 phases that always occur before a collapse. Hedge finance: companies and people take out loans they can pay back with their regular income. It is safe and sustainable. Speculative finance: as the economy grows, confidence increases. Banks start lending to people who can only pay the interest, not the principal of the debt. They bet that asset prices will continue to rise. Ponzi finance: at the height of euphoria, banks lend to people who can afford neither the interest nor the principal. They only survive if the asset price continues to rise indefinitely. And when prices stop rising, everything collapses. Here's what will shock you: this exact sequence happened in 1929, in 1987, in 2000 with the dot-com companies, and in 2008 with real estate. And it's happening now. Let's go back to the beginning. The 1920s in the United States were called the Roaring Twenties, an era of unprecedented prosperity. Between 1920 and 1929, the New York Stock Exchange tripled in value. Everyone wanted to get into the market. Even shoeshine boys were giving stock tips. But there was a hidden problem: margin buying on margin. Investors could buy stocks by paying just 10% of the value and borrowing the other 90%. It was exactly Minsky's Phase 3. People had no real money, just gigantic debts that only worked if prices kept going up forever. On October 24, 1929, Black Thursday, everything collapsed. What followed was devastating. The New York Stock Exchange lost 89% of its value by 1932. 9,000 banks failed between 1930 and 1933. Unemployment hit 25% in the United States. Global GDP fell 15%. Millions lost their life savings overnight. But the most shocking thing was not the crash itself. It was what caused the Great Depression, the paralysis of the banking system. And that leads us to a disturbing question: if this pattern repeats itself, what happened in 2008? 2008 was not an accident. It was a perfect repetition of the Minsky cycle. In the 2000s, banks created a new type of product: subprime mortgages. These were real estate loans given to people without the ability to pay, exactly Minsky's Phase 3. Between 1997 and 2007, mortgage debt in the U.S. jumped from $4.7 trillion to $14.1 trillion. House prices rose more than 90%. But there was a problem: these loans were packaged into complex financial products called CDOs, collateralized debt obligations, and sold worldwide. Nobody knew exactly what they were buying. It was a global financial bomb. On September 15, 2008, the investment bank Lehman Brothers, with 158 years of history and $639 billion in assets, declared bankruptcy. It was the largest bank failure in American history. Panic spread instantly, the stock market plummeted, credit froze globally, large companies couldn't pay their employees, unemployment soared to 10%, 8.7 million Americans lost their homes. Dr. Michael Blakey, who studied the crisis, stated, "It was not a lack of information. It was excessive greed combined with the belief that this time is different." But it is never different. And now comes the part that should put you on alert: the same signs are appearing again in 2024 and 2025. In June 2024, the Institute of International Finance released an alarming number. Global debt hit $315 trillion, 331% of world GDP. It is the highest debt load in human history. But the most immediate problem is in the American commercial real estate market. With the pandemic, remote work left millions of square feet of office space vacant. The value of these buildings plummeted. The problem: there are $500 billion in commercial real estate loans due in 2025. And owners cannot pay. In January 2024, the New York Community Bancorp reported an unexpected loss of $252 million. Its shares fell 38% in a single day. In Japan, Azor Bank announced $190 million in losses linked to American offices. A study by the consulting firm Claros Group analyzed 4,000 American banks and found something disturbing. 282 institutions have high exposure to commercial real estate and large unrealized losses on their securities. These banks are vulnerable, and many are regional banks that serve millions of ordinary Americans. In October 2023, economist Desmond Lockman from the American Enterprise Institute published an article titled, "2024, the Year America Has a Full-Blown Financial Crisis?" He cited Hyman Minsky and wrote, "By continuing to inflict significant losses on bank balance sheets through high interest rates, the Federal Reserve appears to be inviting a full-blown financial crisis." But the most important question is, why does this keep happening if we know the pattern? The answer is both simple and disturbing: short financial memory and institutional greed. After every crisis, regulators create new rules. After 1929, they created the Securities and Exchange Commission. After 2008, they created the Dodd-Frank Act. But there is a pattern. During periods of prosperity, these regulations are gradually weakened. In the 1980s, financial deregulation began in the U.S. Commercial and investment banks, which had been separated after 1929, were again allowed to merge. Minsky publicly opposed this. He predicted it would lead to excessive risk. He was right, but something deeper is at play. Charles Kindleberger, an economic historian, documented financial crises since 1630. He found that they often follow financial or technological innovations: the tulip bubble in 1637, the South Sea bubble in 1720, the railroad fever in 1873, the dot-com bubble in 2000. Every generation believes its innovation is different, that this time is different. Minsky wrote in 1992, "The economic cycle is not caused by external shocks. It is generated by the internal dynamics of capitalist economies and the system of interventions and regulations." In other words, the modern financial system is structurally designed to create these cycles. During good times, stability encourages risky behaviors. And those risky behaviors eventually cause instability. Minsky called this, "Stability is destabilizing." Which brings us to the final question: what can we do? Peter Berezin, chief strategist at BCA Research, predicted in November 2024 that both the US and Canada will enter a recession in 2025. He is not alone. Dozens of economists are making similar predictions. But there is a critical difference: governments are already extremely indebted this time. US federal debt is $33.7 trillion. Interest payments already consume 13 to 15% of the federal budget. This means that when the next crisis comes, governments will have much less capacity to bail out the system as they did in 2008. History doesn't repeat itself exactly, but it rhymes. Financial collapses return because the financial system has a short memory and human nature does not change. Every generation has to relearn the same lessons. And the price of that learning is always paid by ordinary people. Greed is not new, but the cycle it creates is predictable. If this story made you think, leave your like and tell me in the comments, do you believe we are on the verge of a new crisis? Or will this time be different? And if you haven't subscribed yet, click the button because our next episode reveals something even more disturbing: how the $315 trillion global debt is linked to a new form of financial colonialism that few are discussing. You cannot miss it.